Welcome, everybody. Good afternoon, good morning, wherever you are. Welcome to our Seminar. Today, we're here to talk about the Main Street Lending Program. I'm going to invite everyone to please post their questions in the Q&A only. It will be difficult for the moderator to get the questions in the chat and the Q&A section. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com. And later in the day, we will also email a copy to all participants. A little bit about myself. I am the founder and CEO of Multifunding. I am an Inc. columnist writing regularly on business lending issues. I've advised the prior administrations about the business credit markets as well as the Federal Reserve. I have a book out called The Growth Dilemma, and for my EO friends out there, I'm a proud member of EO Philadelphia. Some disclaimers before we begin. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement the program. Multifunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is the time for us as business owners and entrepreneurs to be thinking about what is next for our businesses, to be reimagining our futures. This is the time to be preparing for a battle of reestablishing and rebuilding. This will take a strategy. Will we pivot 5%, 50%, or 90%? This will take sorting out who our team will be going forward. And we will need to figure out what cash or ammunition we need to go into this battle. And this battle ammunition is cash. How much cash will be required to get your business back on a stable footing? What is the best case and the worst case scenario? And where will this cash come from, and how much are you willing to personally risk? And what does your future look like? What opportunities will you want to take advantage of? That is the vein that I want to discuss the Main Street Lending Program with you today. And this program, $600 billion is allocated through the CARES Act. It is expected to open any day. I know we've been saying that for a few days now, and it will be in effect until September 30th, 2020, or until $600 billion goes, whichever is first. It is comprised of 3 facilities: the new, the priority, and the expanded. Let me give you some context about this program. First of all, this is not an entitlement program like the PPP. If your business has been badly hit by COVID-19, your best chance for a Main Street loan will be through your existing bank, assuming you currently have loans with them. If we plan to use a Main Street loan to expand and grow, more banks will be open to you. You'll get one of these loans through a bank, a savings association, or a credit union. But unlike PPP, where almost every bank in America participated, we expect the participation here to be much more limited. To be eligible, your business must be established prior to March 13, 2020. If you and your affiliates have more than 15,000 employees or $5 billion of revenue, you're too big. And your business has to be created or organized in the United States with significant operations and employees in the United States. What is the U.S. eligibility test? The eligible borrower has to have significant operations in the United States if, when consolidated with its subsidiaries, greater than 50% of your assets in the United States, annual net income is generated in the United States, or annual net operating revenues are generated in the United States. Annual consolidated operating expenses, excluding interest expense and other expenses related to your debt, are generated in the United States. Subsidiaries of foreign companies can get the loan as long as none of the proceeds go up to their foreign company abroad. Eligible business types include partnerships, limited liability companies, corporations, associations, trusts, cooperatives, joint ventures, with no more than 49% participation by foreign business entities or tribal business concerns. Ineligible borrowers include developers and landlords and other specific speculative types of industries. Affiliation rules apply on these loans. So an affiliated group of companies can only participate in only one Main Street facilities, and the affiliated group's loan cannot exceed the maximum loan amount for that facility. An eligible borrower's maximum loan size would be limited by its own leverage level, the leverage level of the affiliated group on a consolidated basis, and the size of any loan extended to other affiliates in the group. Let's talk first about the new and priority facilities. They share some commonalities. They are a secured or unsecured term loan. Banks can ask you to sign a personal guarantee at their discretion. They have a 5-year maturity. Principal payment is deferred for 2 years, and interest payments are deferred for 1 year. The unpayment interest will be capitalized. You make a principal payment of 15% at the end of year 3, 15% at the end of year 4, and 70% at the end of year 5. They are priced at an adjustable rate of LIBOR at plus 3%. So currently you could expect or plan for the rates to be about 3.25%. Prepayment is permitted without penalty, and the fees to get in are 1 to 2%. Let's talk first about the new facility, $250,000 to $35 million. How does it work? How much are you eligible for? Well, let's say you have a company with 2019 EBITDA of $500,000. The maximum new loan facility you could get would be $2 million. So to take row 3, that company, if they had existing debt of $1.5 million, you would take 500,000 times 4 to get 2 million. You subtract the $1.5 million, and their potential new money loan would be $500,000. If you take row 1, and that company had existing debt of $500,000, their potential new money facility would be $1.5 million. Lenders have certain rights. In this case, the lender has to share rights with your existing lenders in case of bankruptcy, but it is fluid and flexible what the lender's rights are in a normal world. You are allowed to go get additional debt after you take one of a new loan facility, as long as the rights don't interfere with the rights of the new lenders. The priority facility is between $250K and $50 million. So let's take an example about how that is calculated. You take row 3, a company of 2019 of EBITDA of $500,000, the same company as before, but their potential priority loan facility could be $3 million or 6 times that. That company had existing debt of $1.5 million. Their potential new money loan would be $1.5 million. That same company, if only had $500,000 worth of debt, their potential new money facility would be $2.5 million. What's new about this program, in addition to the 6X instead of the 4X, you can also refinance debt with other lenders into one of these loans. But the lender's rights have to be senior or on par with all of your other lenders except for your mortgage lender. And there are some determinations as to whether the loan will be secured or unsecured. To give you a baseline example, a company with $41,000 of 2019 EBITDA and no debt could technically borrow $250,000 under this program. Now let's talk about the expanded facilities. And these loans, the smallest amount is $10 billion, and the maximum amount is $300 million. So to take an example, a company of $10 million of 2019 EBITDA, the multiplied times 6, so the not to exceed is 60 million. And if they have $25 million of existing debt, they could get a potential expanded loan facility of $35 million. If that same company had $75 million of existing debt, they would not be eligible for a loan under this program. These loans have similar structures as the new and the priority, except they have tag-along rights with your existing lender, and the fees to get in them are 75 bips to 1.5 bips instead of 1% to 2%. What do you agree to if you take one of these loans? You commit not to use the loans to repay other debt that you currently have in the books. You commit not to reduce or cancel your current lines of credit. And you certify that you have reasonable basis to believe that your business is not going to go bankrupt in the next 90 days. You can, while you have one of these loans, repay a line of credit, including a credit card, during the normal course of business. You can take on additional debt as long as the rights of that new lender do not violate the rights of your current lenders, and you can refinance maturing debt. You agree, while you have these loans, to certain certifications and covenants, including stock repurchase and compensation requirements. There are exceptions to these for S corporations. You agree, well, while you have the loan and for 12 months after the loan is paid in full, not to repurchase any equity security of your parent company, and not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earn between $425,000 and $3 million in 2019, you agree to cap your compensation at that level or not to exceed it, while you have not to cap that compensation at that level while you have the loan in for 1 year thereafter. If you earn more than $3 million, say you earn $6 million, take the difference between 3 and 6, you divide that by 2, so you take 1.5, and your compensation is capped at $4.5 million. You agree to make reasonable efforts to retain your employees while you have the loan, but these standards are nothing like the PPP. The primary agenda here is to save the company, not to save the jobs. Bank will, if you're working with a bank you've previously worked with, they will calculate your EBITDA in the same way they have done it before. If it is a bank that you've not worked with before, they will have to calculate your EBITDA or any adjustments you're asking them to consider in a way they have done it historically for similar companies like yours. Your debt will include all existing outstanding and undrawn available debt based on the date of your application. If you have an asset-based line secured by accounts receivable and inventory, that amount you've borrowed against it instead of the amount you could borrow against it will be calculated. How do you pick between the new priority or the expanded? Well, just to take an example, in row 3, a company with $6 million worth of EBITDA and $15 million worth of existing debt to get a new facility of 9 or priority or expanded of 21. It would be a matter of how much money you thought you need, what the banks would be willing to do, and what made most sense for you. Financing strategy is like playing offense and defense. Let me share with you 3 quick case studies about how business owners and entrepreneurs are planning on using the Main Street lending program. Example number 1 is a company with a $3 million line of credit and $1 million drawn against it. The line of credit has a personal guarantee. They are planning on getting an MSLP for liquidity. They would rather not PG the capital required to reestablish the business. Example number 2 is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And example number 3 is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. How much money will be required to get your business back on a stable footing? What is the best case and the worst case scenario? Where will the cash come from, and how much are you willing to personally risk? And what does your future look like, and how do you think these things through? Thank you for your time. I'm now going to ask the moderator, who will be happy to take your questions. Again, please post your questions in the Q&A instead of the chat. And if you have PPP or EIDL questions, we'd be happy to take them at the end. Thank you, Hannah.
Thank you, Ami. Would this work for a residential construction company?
There should be no reason it can't, as long as you are not, if you're simply building as a service for other customers, there should be no reason, as long as you have the EBITDA to back it up, that a residential construction company would not be eligible.
We are open to all questions, ladies and gentlemen.
Happy to take your questions if you have them. We have a quiet crowd today, Hannah. It's very
Yes, we
unlike.
do.
Happy to take questions if you have them, or if it was all perfectly clear. Hallelujah. Questions going once. Questions going twice. Questions are done. We thank you for your time, ladies and gentlemen. We will be sending you a copy of these slides and the recording shortly. We wish you well and happy to help you in any way you can if you need it. Thank you so much. Take care.
Thank you.